Barbara Goldberg Goldman. I'm founder and co-chair, along with Ralph Bennett, of the Affordable Housing Conference of Montgomery County. And I know many of you joined us for our 29th Affordable Housing Summit on October 2nd, and again for subsequent webinars on October 30th and December 7th. We're delighted you're joining us again today. Those of you who are here for the first time, I hope are going to find today's sessions very thought-provoking and informative. The Affordable Housing Conference is a 501c3 dedicated to the mission that decent, safe, and affordable housing here in America is a right and not a privilege. And we take on many, many, many issues. In fact, as we speak, we have an issue before the County Council tomorrow where we are advocating and supporting for $100 million in bond financing, as well as a $50 million revolving loan fund. So keep your eyes open and look out for that, Montgomery County residents. With the COVID pandemic surging and placing enormous financial strain on homeowners here in Montgomery County and across the country, we have convened a very distinguished panel today of housing finance and mortgage executives. Guided by their expertise and experience, today we examine the trends and challenges of homeowner access to forbearance and looming foreclosure crisis, and what this portends for home ownership in the coming years. Yes, in affluent Montgomery County, according to many of our colleagues across the state and nation, Montgomery County is suffering just as much as every other community. Before I introduce our distinguished moderator, we invite you to submit questions using the Q&A button. We'll all save time towards the end of the panel to answer as many questions as we can. Our discussion today will be recorded and it'll be available on Facebook and the Affordable Housing Conference of Montgomery County website. I do want to give a shout out to our executive director, Diana Eisenstadt, who put this program together in our series of meeting and discussing with the experts. We want to welcome Barry Zegas, who will moderate this panel. Barry and I have known one another for many, many years, decades, I believe. He is a senior fellow and former director of housing policy at the Consumer Federation of America. He consults with housing and community development nonprofits and foundations through his firm, Zegas and Associates. Barry served as Senior Vice President for Community Lending at Fannie Mae for over 10 years, and also as President of the National Low Income Housing Coalition. He is a trustee on numerous corporate and nonprofit boards, and we welcome to you, Barry, and our panelists. So Barry, take it away.
Barbara, thanks so much, and thanks to all of you who've dialed in this morning for this panel conversation, and of course, thank you so much to the panelists who've agreed to join. We are going to be exploring some of the issues that surround mortgage forbearance and homeowner experiences during the pandemic. We've had prior conversations that have focused more on rental, but as I'm sure many of the people on the call know, the CARES Act adopted last year provided for forbearance options for homeowners who were facing financial hardship or were afraid they were going to face financial hardship. And today's panel, we're going to explore how that's worked out, what the current status is, some of the issues that have arisen as consumers have sought that relief, how it's affected financial services organizations, and some emerging insights into how it's working nationally and also bring it down to the local level at Montgomery County. We have a terrific panel assembled here today. I'm going to introduce them very briefly, and then we're going to just go one by one. So we're joined by Mark Palin, who is the VP and Deputy Chief Economist at Fannie Mae. Dr. Palin oversees the Economic and Strategic Research Group's forecasting functions and manages multidisciplinary partnerships across the company. Mark is going to share with us kind of the big overview that Fannie Mae, in its role in the mortgage system, has, its line of sight into the use of forbearance and what they've experienced. And he'll be followed by Bob Brooksmith, who is the CEO of the Mortgage Bankers Association, a good friend and colleague. Bob has been in the business for 35 years as a senior finance executive and corporate officer. He's worked at what I call the pointy end of the stick, directly in consumer finance, and has proven as being a great leader at the MBA. And Bob is going to share MBA's sort of more amplified line of sight, particularly with regard to servicers and what they're experiencing during this effort. And excuse me, MBA, of course, represents lenders of all types, including depositories and independent mortgage bankers, who are a growing and very important force in the mortgage system. He'll be followed by Chris White, who's an SVP, Senior Vice President and Head of Default Client Operations at Truist, which is formerly SunTrust Mortgage, has over 30 years of experience working in this sector, including asset management, capital markets, and other areas. Chris is going to have to leave us at the half-hour mark because of some unavoidable conflict at the office, but we're thrilled he'll be here to talk a little bit about Truist's experience. Chen Zhao, who's the Research Lead Financial Markets and Housing Finance staffer at the JPMorgan Chase Institute, tremendous source of information and research for our field, is going to be describing some recent research she and her colleagues have carried out looking at how forbearance was used, who benefited from it, and how it operated. She has been, prior to JPMorgan Chase Institute, joining there in 2016, Chen was an economics consultant at Analysis Group, Inc., where she worked on financial litigation cases and led teams conducting health, economics, and outcomes research on behalf of pharmaceutical companies. We're going to wind up with the local perspective from a former colleague and good friend of mine, Frank Desmarais, who's the Deputy Director of the Department of Housing and Community Affairs in Montgomery County. Frank has managed and developed a broad range of local and national programs in the housing industry since 1979. And as I said, is a former colleague of mine at Fannie Mae and has experience in the nonprofit development sector in the Washington area as well. So with those introductions out of the way, I'm going to turn the microphone over to Dr. Palem, who's going to take us through his initial comments, and then we'll go right through the rest of the agenda. Mark?
Great. Thank you very much. I really appreciate you inviting me to join today. And I was just going to run over a couple of things fairly quickly, and then the Q&A is obviously the most important part of today, to hear from the participants. So I think the first important point to make about forbearance today in this crisis is that the types of forbearance and how we are managing the process across all the different federal agencies, and frankly across practically all the lenders, really takes into account the lessons that we learned from the crisis. And I think the most important lesson that we learned from the financial crisis and the housing crisis in the mortgage servicing area is you really need to try to keep the options as simple as possible for the borrowers, simple as possible for the servicers, and then most importantly, you need to not lose contact with the borrower. I don't mean simply in the sense of losing their address, but in the sense of losing trust and communication, or they're just overwhelmed, or for a whole bunch of reasons, you no longer have a borrower who's communicating with you. So with that in mind, what was different this time around? The program that was rolled out right before the CARES Act at the GSEs, and obviously all of this involved FHFA and Freddie and Fannie working together. I don't want to in any way try to take all the credit here for Fannie. The GSEs working together, it basically had one question, as opposed to all the paperwork that was required in the past. Have you been economically affected by the COVID pandemic or the downturn? If the answer was yes, then your servicer gave you 6 months forbearance. Of course, I'm sure everybody on the call realizes forbearance is not forgiveness. You still owe the money at some point eventually, or you're going to have to get a modification or some other change to your mortgage. So it's always important to keep that in mind. You could ask for 6 months, and then you could get an extra 6 months after that. And that process kicked off last March, pretty quickly after the first lockdowns, et cetera, went into effect. So a much simpler process. On the communication side, you've also seen Fannie really try to communicate broadly with the public, as have other financial institutions, both through our website and also through what you think of as advertising, public service campaigns, et cetera, to make sure that people know what their options are. And we actually have a website dedicated with that name, Know Your Options. So since I'm an economist, I have to give you a little bit of data. And here I have to look at my notes. If you go back to February of 2020, at Fannie Mae, we had 6,000 single family home borrowers in forbearance. out of a total of a little over 17 million single family loans. By May, that number had surpassed a million. So obviously a dramatic increase in the number of borrowers taking advantage of forbearance. Part of what we saw subsequent to that was that quite a number of borrowers had taken what you might describe as a precautionary forbearance. So they called, they got a forbearance, but they actually kept paying their mortgage. So if you fast forward to a little later in the year, by the end of the year, the stat that I have is of the 1.2 million single family owners that entered into forbearance, at least 44% had exited by the end of the third quarter. Sorry, not the end of the year, but the end of the third quarter. And of those, 94% were either current, had paid off their loan in full, or were taking advantage of some other repayment option or loan modification. So you saw people cycle in and out, and I'm sure Bob's going to provide some more data around what you're seeing in the broader market. That's been the other really noticeable phenomenon around this. Secondly, since my team does the economic forecast, it probably makes sense to provide a little bit of a view around what was the context for this. So looking back at the economy over the last year, unemployment rate peaked at 14.7% in April when the economy was shut down. Since then, we've seen significant job gains, and unemployment has now declined to 6.7%. So that's a meaningful improvement that has really helped many borrowers continue to pay and not need forbearance. But that number is a little bit overstates how much the improvement is, as I'm sure many of you saw in the employment report. We're still 10 million jobs below the number of jobs that we had in February before the pandemic began. And at least in our forecast, and this is really not different than many other forecasters, we don't see the level of employment in the economy returning to where it was in February until well into 2022. So you're going to continue to see borrowers who are going to need to get some sort of assistance or the other one. In terms of where is the housing market compared to where we were last time, I think that's a really important difference. This time around, you've continued to see pretty strong home price affordability, appreciation, which obviously is not helpful for affordability, but it does help borrowers who, if they continue to have difficulty paying their mortgages in the future, in that they have more home equity. But anyway, that was the information I wanted to share to set the stage for the discussion. And Barry, back to you.
Terrific, Mark. Thanks very much. Bob?
Good morning, Barry. Thanks for moderating. Thanks to the conference for having me. I am a longtime resident of Montgomery County and spent from 1996 to 2010 at Chevy Chase Bank, of course, headquartered right there in Bethesda, and been very active in efforts in the county. Not so much now that I have a national post at MBA, but very glad to get back into Montgomery County issues and to see old friends from Fannie Mae days, and also happy that Truist and JP Morgan Chase, who are both, we're proud to call both of them members of MBA, are also on the panel. I want to just say a few words about forbearance and how people get into it, and then what happens when it's time to exit. So as Mark said, you could get up to 6 months. You actually need contact with the servicer to get a second 6 months. So it's something that we worried about because some borrowers are reluctant to be in touch with their servicers when they're in a situation where they can't pay their mortgage. And so we have joined with a lot of other industry participants to have, including the CFPB, to give it that seal of approval from a consumer-oriented government body, to encourage borrowers to either be in touch with their servicer or a HUD-approved housing counselor who can then intervene on their behalf, to ensure that at the end of 6 months, they know that all they have to do once more is call the servicer and say, I continue to have a hardship related to COVID, and then they get the automatic extension for up to a year. So that's very important. And we're heartened by the smaller percentage of borrowers who are going off forbearance as their initial forbearance period expires. So, and another thing I'd like to mention, give you a few statistics. There are now about 2.75 million borrowers in forbearance, and it's much more prevalent with FHA and VA borrowers. We do a weekly survey of our servicers, and the most recent, we're going to come out with a new number today, but the most recent number we have is 7.92%, or almost 8% of Ginnie Mae loans, which are FHA, VA, and USDA loans, are in forbearance, while at Fannie and Freddie, it's 3.24%. And that is, I suppose, not very surprising, because FHA borrowers, who are the primary part of the Ginnie Mae forbearances, generally have lower down payments, lower reserves, less cushion, and perhaps are more apt to be employed in some of the lower paying professions that have been hurt so badly through the economic fallout of this pandemic. So we are more worried, frankly, about outcomes for FHA borrowers than we are for Fannie and Freddie borrowers. As Mark rightly mentioned, we entered this crisis with a record of home equity in this country. But of course, that's more apt to be among conventional borrowers than FHA borrowers, who tend to be first-time home buyers and lack generational wealth. So we're really, one of the things that I was asked to think about a little bit is, what should we be worried about? Well, what we should be worried about is that the 12-month forbearance will end around March or April, depending on when the borrowers first entered. And there's all kinds of great options for borrowers who are back on their feet. But for borrowers who are not, you can't modify a loan if the borrower has no income, right? I mean, what payment would be affordable if the income is zero? So that's what we have to worry about. And whether the Biden administration, together with FHFA, although FHFA, again, is not really, we're not so worried about Fannie and Freddie as we are about FHA. So will the legislature do something to say, all right, if borrowers are still affected, understanding that the vaccine is on the way, and perhaps there'll be some move to move beyond a year. I don't know whether that's going to happen or not. And one other thing I'd like to mention, and then I'll hold the rest of my comments for the question period, is that as Barry rightly said, forbearance is not forgiveness. And the longer a borrower stays in forbearance, the more equity erosion there is. And what I mean by that is that when you, let's say you have $1,000 a month mortgage payment, well, probably 950 of it or so is interest and only 50 is principal. And I was erroneously under the, I mean, I hadn't thought it through. I thought, well, you're not losing much equity because it's only $50 principal reduction that you're foregoing. Well, guess what? The interest gets put on too, right? I mean, you're not paying interest on interest. It's set aside in a separate account. But if you have $1,000 payment and you're not making it, and let's say you don't make it for a year, that's $12,000 added to your loan balance. Now, you don't have to pay it until you pay off the loan, but it really quickly erodes equity. So there has to be a solution for borrowers who will not ultimately be able to retain their homes. This is, people don't like to talk about this, but this will be part of the process for some. And the policy question is, how much extension should be granted so that it's still good for the consumer, as opposed to just putting the consumer in a hole that would be really hard to dig out of ultimately as it relates to their equity. So Barry, I'll leave it at that, and then we'll follow up on the question period.
Bob, thanks so much. That was great. Chris, I know you're pressed for time, but in the time you have remaining for us, this sort of puts us right in your wheelhouse. So talk to us a little about what it's been like on the front lines, what you're seeing among your own customer base, and where your worries are.
Yeah, great. So first of all, thanks for having me, and yeah, a lot of great points on those from the first two speakers there that kind of flow really into my organization and what we do perfectly. Just want to probably provide a little bit of the journey that we've seen from a servicer perspective here at Truist. Obviously, I kind of marked the start of this 10 months or so ago on March, Friday the 13th is when I kind of, in my head, recall my call center teams, and at Truist, just for I have the collections unit, I've got our home preservation call center unit, and I've got also loss mitigation. So they all flow and obviously have been very integral into servicing borrowers who have been impacted by COVID-19. But definitely on March the 13th, we really started getting hit with a lot of inbound volume from borrowers who were being impacted by furloughs, layoffs, whatever you would like to call it. And we're looking for options and from a payment assistance perspective. And those volumes, to kind of put it bluntly, were about 7 times normal volume in those call centers. So we initially saw very high abandonment rates, wait times, et cetera. And to date, just to put a little bit of numbers around it, at Truist, we have assisted just north of 100,000 borrowers in forbearance. Where we stand today, and it kind of alludes to a lot of the comments you've seen thus far, active remaining in our organization in Truist right now is just north of 30,000. Now there's a little population, there's another population there that we continue to work through the post-forbearance processes, but that's kind of where we stand today. What we've noticed, and I think those numbers, if you think about it, kind of allude to some of the additional comments that we heard earlier. We saw a lot of borrowers coming to us really not knowing what was around the corner for them. So they were looking for forbearance kind of protection. I want to go ahead and get a forbearance. It's kind of like an insurance policy to some degree, for lack of a better description. I just don't know what's going to happen. I'm anticipating potentially being impacted. And so I want to go ahead and ask for forbearance. And then with the low hurdle to get that forbearance, it made it very easy for borrowers to get that option. But we've quickly seen, though, a lot of folks assess that whether they've been truly impacted or not. And if they have not been impacted, we've seen a lot of borrowers continue to pay or reinstate. And with a low interest rate environment, we've seen a lot of those folks come off of forbearance, reinstate, and move on down the refi path. So that really kind of gets us to a point of what remains as we approach, I think to Bob's point, what remains as we approach the 12-month mark for those initial folks is going to be a far more sticky, difficult type of process to move them from forbearance to their post-forbearance options. Let me just, so as I set that ground a little bit with a little bit of the data that I wanted to bring to the group, we've evolved a lot at Truist, and I know other servicers, as colleagues of mine at other institutions, we all converse, we understand what folks are doing. Clearly, no one on March the 13th was ready for the amount of volumes that we saw, right? And so we quickly pulled all resources within the bank, coming together, incorporating and implementing new phone technologies to make it far easier for our borrowers to engage us, to answer the phones in an adequate amount of time. And then really one of the biggest things that we incorporated was a COVID-19 portal, essentially a digital portal for borrowers to go in. They could clearly, they could come the traditional phone route. They could go in and self-service themselves with a big suite of educational materials. And then they could also actually request forbearance assistance through this portal, which made it very, very nicely if the borrower didn't want to hold, or if the borrower felt comfortable in educating themselves, they can make a decision then and there. That portal is useful still today from whether they wanted to extend their original forbearance term, or it also provides education and the ability to direct post-forbearance options that the borrower would like to take. On the back end of my process, we also incorporated a lot of bulk batch automation in order to incorporate these volumes, get these borrowers set up in a quick turnaround time into forbearance. So that has worked wonders. I heard a little bit, I thought I would also talk about just real quickly some of the additional outreach that we've done. We've looked at our portfolio, and for those that aren't aware, that 100,000, just north of 100,000 mark is less than a little less than 10% of our overall servicing portfolio. As we've gone on through this journey, we've also looked at our delinquency reporting, and okay, who has remained delinquent but has yet for some reason or another to engage us about forbearance and those needs. So we've done a lot of analytics around that. We've partnered with our retail community bank branches to assist us in outreach to borrowers for whatever reason, whether as we've outreached to them, they haven't engaged us, or they haven't engaged us from an inbound perspective, to assist us in looking for borrowers who, hey, look, we understand, you may have a hardship. We want to engage you. There are options available to you. So looking for some other avenues for outreach. We've also partnered with a few different nonprofit homeownership organizations to try to be a bridge to that engagement, because a lot of times nonprofits, homeownership counseling services, things like that are trusted, and it's a great way to kind of bridge that gap to maybe borrowers who may not be as trusting to their mortgage servicer. So some out of the box things like that we found very beneficial. So like current state, where are we? Obviously, as mentioned before, we are quickly approaching that 12-month mark for those borrowers who engaged us in March. So we're starting to think about that. We're thinking about that. We're engaging those borrowers, talking about post-forbearance options. The other thing mentioned, borrowers who may not have income, right? They were laid off, furloughed, whatever the case may be, trying to think about, what options are available to them, whether it is, a liquidation conversation, thinking about equity in their homes, things of that nature, having those kind of difficult conversations, training our people to have those difficult conversations. So those are the things that we're thinking about. Also, the unknowns, as kind of mentioned before, the legislative environment, what's going to change, the extension of CARES, what does that have? How does that look? Will that happen? Other communications around, foreclosure moratoriums. Even from an internal process perspective, what does the winding down of CARES or COVID relief look like from a process perspective and a client communication perspective? So a lot going on. A lot has occurred over the last 10 months. We know that this will go on throughout 2021 as folks slowly come up on their 12 months in forbearance. So a lot in the way of client education and understanding what the industry is doing and what's going to come out from a legislation perspective. So that's it. Barry, I'm going to turn it back over to you.
Chris, terrific. Thank you so much, and thank you for joining us in the middle of what I know is a busy and unexpected workload that showed up for you on Friday afternoon. So thank you very much for joining us. That was terrific. Chen, you've been looking at some of these broader issues in terms of impact on borrowers, impact on servicers, how the forbearance process really worked for consumers. Please share some of your findings with us.
Thanks so much, Barry. Hi, everyone. I'm joining today from the JP Morgan Chase Institute. For those of you who may be less familiar with us, the best way to think about us is we're an economics think tank within JP Morgan Chase. We have a public good mandate, so we're not part of any of the commercial parts of JP Morgan Chase. And all of our research is freely available on our website, which is at jpmorganchaseinstitute.com. I actually, like Barry said, will be sharing the results of a study that we did today. So I have a couple of slides I want to show you. So I will attempt to share my screen here. Let's see. All right. Hopefully everyone can see my screen now. Great. I see nods. Wonderful. All right. So As many of the folks on the panel have mentioned so far, the CARES Act mortgage forbearance policies were a bit different than policies of years past. And so what we wanted to do was to study, well, given that mortgage forbearance was made so easily available to homeowners this time, with essentially no documentation requirements, what can we say about whether or not these forbearance policies reached the right homeowners? That is, were those who were in need, did they actually get forbearance, and did they make use of it? And were there instances where people who didn't need forbearance actually took advantage of the program? So in other words, moral hazard. And the way that we're going to approach the study is the JP Morgan Chase Institute leverages JP Morgan Chase's proprietary administrative data in de-identified form to do our studies. So the data that underlies this study is loan level data from Chase Home Lending. So these are all the loans that Chase services that has been linked to Chase deposit account data. So essentially think of the people who are in the study as having a Chase mortgage and also a Chase checking account. And because of that, we're able to see loan characteristics, what happens to the loan, as well as what is happening to income and assets for borrowers. All right, so today I'm just going to share 3 or 4 charts from our study. The rest of the study is actually available on our website, so please feel free to click through and take a look at the rest of it. Oops. Sorry, here we go. So to set the scene, as many have mentioned so far, there are essentially 4 groups of borrowers that we're interested in, right? So the largest group, 89% of borrowers in our study, are in this kind of light blue group. They were not in forbearance, and they also did not miss any payments, right? So this is most people kind of just going on with life as usual, as you might say, right? 9% of borrowers were in forbearance in our group. But not all of those borrowers actually missed payments. In fact, only 2/3 of them missed at least one payment between April and August, which is the time period that we're studying for this report. And 1/3 of them continue to make all of their payments. So that's the 3% in this table. And then there was also, in addition to this, a small group, about 2% of the sample, that were not in forbearance, but actually went delinquent. So they missed some payments. And for some reason, they did not enter into forbearance. So what we're going to do is look at what is happening to income and liquid assets for these 4 groups of borrowers. So in this first chart, what I'm looking at is what I'm going to call total income. So total income in our data is basically measured as all the inflows into your checking account minus transfers that you make to savings and investment accounts, right? So this is an approximation of basically your income. And in this chart, what we're doing is we're showing the income patterns of 3 of the groups relative to the baseline group. And the baseline group here is that large group, the 89%, who continue to not be in forbearance and to make all of their mortgage payments. So these are the bulk of the sample. So what is happening to everyone else? Well, what immediately jumps out is that those who are in forbearance and who actually miss payments. So this is the dark red line here on this chart. I don't know if you can see my cursor, but the dark red line here, they had the worst income trends. They lost the most income, and then throughout this whole period, they had the worst income trends relative to the baseline group. Those who are actually in forbearance and then continue to make their payments, so this is kind of this peach orange line here, their income was fairly similar to the baseline group. And then there's a small group here that missed payments but were not in forbearance. They also saw their income drop relative to the baseline group. So what can you conclude from this table? What I take away is that, well, those who actually missed payments, those who actually went delinquent or used forbearance and missed their payments, suffered worse income trends. And the main takeaway here, what I would say, is that those who actually took advantage of forbearance programs to miss their mortgage payment, they were in need. You can clearly see that they actually saw large income groups or income drops relative to the other groups. And in fact, it was not the act of signing up for forbearance that was a distinguishing factor. It was actually missing payments while you were in forbearance. I'll just show you 2 more charts in the interest of time today. The first is another way to look at income. So what I showed you before was median income trends. This is trying to show the distribution of income changes for these 3 groups, three groups that I'll describe. So the x-axis here is showing you what is happening to income. So there's 5 different groups. So on the left, you have people who had very large income declines, and on the far right, you have people who actually had income increases. So income in checking account data is very noisy. So you have large declines and increases all the time. That's something that's very important to keep in the back of your mind as you're reading this chart. This chart talks about 3 different groups of people. The red group are people who are in forbearance during COVID and who actually missed payments. The blue group is people who missed payments during COVID, but who were not in forbearance. So they didn't have the protection of forbearance, but they had to go delinquent for some reason. And then the gray group is people who went delinquent on their mortgage, but in 2019. So this is before COVID happened. And the reason I'm comparing these groups is because I'm trying to answer this question about, did people take advantage of forbearance? Were they using forbearance when they didn't need it? And I think the main takeaway here is that the income distribution, the distribution of income changes for these three groups is actually pretty similar. If anything, probably the red group skews a little bit to the left relative to the other 2 groups. And why is that important? Well, the people who went delinquent in the blue group and the gray group, they didn't have forbearance as a protection. They went either delinquent before COVID hit, or they were not in forbearance at all during COVID. So the people who actually used forbearance to miss payments, they did not, if there was a lot of moral hazard, is another way of putting it, if there was a lot of moral hazard and people were taking advantage of the forbearance programs, what you would expect to see is that the red bars would skew far to the right relative to the blue and the gray bars, but that's not what we're seeing here in this data. All right, and then let me show you one last chart in the interest of time. In this chart, we're looking at 2 different groups of people. On the right side, these 4 bars here, this is the entire population in our study. This is what I've already shown you before in the first chart, where you have 89% in the baseline group and then 6% in forbearance and missing payments, et cetera. On the left here are people who received UI benefits that we can see in the data. So these are people who lost their jobs during COVID and started receiving unemployment insurance. And what we wanted to do was to look at how these 2 groups differed and whether or not they were in forbearance and missed payments. And what immediately jumps out is that 84% of the people who received unemployment insurance, they were in forbearance, right? So they signed up for forbearance, but they did not miss any mortgage payments. They continued to make all of their mortgage payments during this period. And if you compare that to 3% of the entire sample, that's a huge difference, right? So what is happening here? What I would argue is that when these folks lost their jobs, they signed up for forbearance. And as some of the other panelists have pointed out, they signed up for insurance purposes, essentially. They didn't know what was around the corner, so they wanted forbearance. But when they received their UI benefits, and as we all know, UI benefits were unusually high during this time period, they continue to make their mortgage payments. So when they have the ability to pay, they continue to pay. That is, I think, the main takeaway from this chart. So what are we seeing in the data? Essentially, what we're seeing in the data is that I would say, 1, forbearance helped a lot of people who were in need. People who had large income drops sought out forbearance and they used it to not make their mortgage payments, essentially. We do not see a lot of evidence of moral hazard in our data. I think if you talk to folks, you will undoubtedly find anecdotes of examples of people who will say, well, I know one person who could have made mortgage payments but did not. I think you'll definitely, it's inevitable you'll hear those anecdotes. We would argue that the cost of that small amount of moral hazard is small compared to if the CARES Act had been structured differently and had very high documentation requirements, and a lot of people were not able to take advantage of the program, right? So all in all, I think what we found in the study was that the CARES Act was actually very successful, at least the forbearance portion of it. It made forbearance available to those who needed it, and we did not see widespread moral hazard. So as I said, the charts that I shared today are just a few of the charts in our report. So I would invite you to go to jpmorganchaseinstitute.com. You'll see the study right at the front page, and you can click through to see some of the other findings that we have. We also looked at how savings changed in particular for these 4 different groups. So I'll conclude there and turn it back to you, Barry.
Jen, thank you so much. Terrific work, very valuable. Just quickly, can I ask, Were these all loans serviced by Chase or loans originated and held by Chase? Can you say a little more about the composition? And then did it include conventional as well as FHA, VA mortgages? What was the composition of your sample like?
Sure, yeah. These are all loans that are serviced by JP Morgan Chase. Not all were originated, but the bulk were probably originated by JP Morgan Chase. This includes GSE loans, FHA loans, VA loans, and also portfolio loans. Chase historically, or Chase, I guess more recently, as you know, you can read in the press, does not actually have many FHA mortgages. So that's a small, very small proportion of our sample, but there are some.
Terrific, thanks very much. So Frank, this brings us to you, and to share a little insight into how this is playing out at the local level, the role the county's playing, and some of the things you see coming up over the horizon in this arena.
Okay, so thank you very much, Barry, and welcome to all our Montgomery County folks. The foreclosure homeownership challenge is different and lower profile than what you've been hearing and seeing on the rental, but we recognize that we do have, a growing challenge. The foreclosure forbearance has really slowed things down. But in the county, we're looking at and dealing with the COVID emergency as first response and then recovery. And the state on the response side has implemented some controls on foreclosure activity. So actually right now until the end of January, the courts will not process a notice of intent to foreclose. Past that, after January 31, any action actually has to follow a set of protocols on notices to the homeowner about the availability of foreclosure. So there's some controls that are placed through the state process, the court process, governor's executive order. In the county, our focus has been on outreach and assessment, counseling available through the nonprofits that are supported by the state and the county. We also had focused on trying to get arms around the extent of the impact, particularly on our homeownership associations, condo associations. Over 40% of the population of Montgomery County lives in homes as part of a association. And we actually offered support for associations that experienced significant loss of association fees. And we found very low impact from the current income losses and situation on the HOAs and condos. We've done a very broad survey, covered over 20% of the HOAs and condominium associations, and found very low numbers. It was less than 0.5% increase in delinquencies in the receipt. We do have associations which have delinquencies and distress, but longer term. And right now, from what you're hearing on the forbearance side, there is a process where fortunately homeowners are able to maintain their association payments. And so we're not seeing the kind of distress that we anticipate, but this is all leading up to the assessment we have to go through on our recovery side. And so from a looking forward, we know that we have a very large number of homeowners in distress financially, from an employment perspective. We very much promote and support information getting out on all of our economic support. I mean, we have homeowners that need food support. We have homeowners who need a lot of other economic support. That's available. County's main websites, the help page lists all that. At the Housing Department of Housing Community Affairs, where I'm the deputy director, we have a separate COVID page for our homeowners, and we highlight all of the forbearance information. We highlight all the other resources and support available to homeowners. But we know that we really across the board in the county, the focus on this current emergency is to try and learn from where we are. We're exposing a lot of weaknesses that existed prior to this and try to anticipate how to come out stronger. We recognized in the last cycle the loss of home ownership, particularly among the communities of color, particularly among African-American community, the devastating impact on the loss of home ownership progress that have been made. So we're very focused on what and how we can help support and address that. Right now, we believe that the servicing community and the rest of the mortgage community is doing a very effective job reaching their borrowers. We're trying to support that with the information, the organizations, and the county resources that are available. And so as we move forward, we're very much focused on connecting people with the available resources. We have provided rental assistance, money to the tenants that goes to the landlord to avoid the loss of housing. We're focused on what we can do, but we do not have currently any programmatic or structure for providing financial direct assistance to homeowners other than helping connect them and support them in working with their servicer and protecting their housing through that process. So the county will continue to do outreach and support, and we're going to continue to try and expand and support homeownership opportunities. Barbara mentioned at the opening here, ongoing efforts to continue to expand the supply of housing. We think it's very important while we're going through this, and the budgets are going to be absolutely constrained, but that we need to maintain what we've been doing, and we need to continue to try and expand, particularly home ownership opportunities, equity, and wealth building that will sustain people through future downturns. So we're not losing sight of that, but it will be a challenge as we move forward to make real progress. So we're maintaining that as our focus coming out of this, whenever that is. And in the meantime, anyone that you're working with, connect them to the county's website resources, the Department of Housing Community Affairs, the homeownership links we have in there, the help information. We have significant distress going on in our communities that previously in the homeowner community had not seen this kind of distress on the personal side. So we need to respond before we get to recovery. So with that, I'll see if I can help with the questions that come up about the local activities.
Terrific. Let me thank everyone on the panel for terrific insights and additions to this. If I could just sort of summarize what I've been hearing on this. The first is that it's worth stopping and realizing and appreciating that the provisions in the CARES Act that were designed to protect homeowners from the unexpected calamity that befell all of us in the early part of the year seems to have actually worked and seems to have accomplished what it set out to do. And in this day and age of cynicism about government and Congress's ability to do anything right, I think that's something worth celebrating. And I think some lessons that came out of it can be summarized as, first, we learned a lot from the crisis in 2008, 2009, where the industry was really caught completely by surprise by an enormous downdraft in the business, a lack of capacity to service the consumers who were suddenly facing great distress, and a lot of it exacerbated by the fact that we had allowed the mortgage industry, the mortgage landscape, to become populated by a very wide variety of non-standard products, many of which were not friendly to consumers and ultimately not friendly to investors, left many consumers and investors and lenders in a precarious financial position. And of course, we saw a gigantic loss of home equity during that period, which made recovering from mortgage distress much harder. In the interim, the mortgage system has kind of been reset. We don't see borrowers, for instance, struggling now with exploding arms, with terms that are suddenly changing on them. And we see the proliferation and the standardization back to what I would call plain vanilla mortgages. And I would argue that's one of the things that has made this an easier crisis to manage, in the sense that we weren't trying to deal with an enormously diverse set of mortgage products, lenders, investors, all of whom had disparate and competing interests. So that's a lesson, I think, to be learned. Second, that erecting high barriers to participation in programs of relief in time of emergency can really be counterproductive. And that one of the lessons we learned in 08, 09 and carried forward, as Mark said, by enabling this to be consumers to get forbearance on their mortgages with a low barrier to entry meant we had a much higher level of pickup in a much quicker time frame. And as Chen has suggested, and it wasn't abused. As she said, yep, sometimes people do slip through, sometimes there's abuse, but on the principle you don't let the perfect be the enemy of the good, one of the lessons here is that low barriers to entry for consumers in a time of need actually turns out to be sound public policy. The other thing that Mark and others mentioned is the ability and necessity to be able to scale up very quickly from what I would call a baseline level of interaction with consumers through servicers, the ability to scale up very quickly became critical, and the industry really stepped up. I was on hours of phone calls as a consumer representative, working with the industry, and as Mark and Bob pointed out, an enormous amount of effort and expense went into trying to find ways to reach consumers, enable them to reach people in the lending community more quickly. And as all of us have commented throughout this crisis, this call is an example. My gosh, where would we all be without the internet and Zoom if a similar crisis took place? As Chris pointed out, the ability to use technology to enable consumers to get quickly to solutions, quickly to education and information, as opposed to what we saw in 08 and 09, where people were struggling with long wait times on the phone and transferring documents to fax lines and losing documents. Technology has proven to be an enormous support in this area, and we're lucky to have it. Chris also mentioned the role of nonprofit housing counselors, and I know MBA has been a tremendous supporter of that work, and I'm sure Frank has seen their benefits locally. We had pending issues. So what's next? What happens to all these consumers who will be expected to start making payments sometime in the first or second quarter of this year, who may or may not have recovered economically, and what will Congress do to confront that, and what will the industry do to confront that? And Bob raised the issue of eroded equity. How do we work with consumers who will find themselves now with a mortgage that's potentially several $1,000s bigger than it was when they started and has to be paid off in some way? I want to turn quickly to some questions, then one of which came out of the audience, well, let me start first. Chen shared data from the Chase database, and I'm just curious quickly if Chris and Bob and Mark, do the findings that she shared with you track with what you're seeing in your industry surveys, Chris, in your portfolio, Mark, in your portfolio?
Well, I'll start.
Yeah.
Oh, go ahead.
I was just going to say, and then just real quickly, yeah, I think what Chen provided and gave a nice overview on, I would say aligns pretty well with what we've seen in the Truist portfolio.
Yeah, and I would just say that our weekly surveys, we think, capture about 75% of the mortgages in the country and are very consistent with what we're hearing on the call today.
Yeah, and the consumer surveys that we've done, clearly losing your job is the trigger for getting forbearance. It's the biggest when you just ask people. So losing your overtime, other things, and when people think it's a permanent loss of job in particular.
Yeah. So one of the questions that came in from the audience had to do with an aspect of this we haven't yet touched on, which is the degree to which we're seeing disparities in both the take-up of forbearance by racial minorities, by first-time home buyers, people in census tracts that are predominantly minority, and people of color. Chen, did your data show anything that gives any insight into that?
So that's a really great question, and the one that we're very much interested in as well. Unfortunately, that's not something that we've been actually able to look into in our data right now, but we have a follow-up study planned for publication probably this summer that we hope will address exactly that question. So stay tuned is the best answer I can give right now.
Terrific. Mark or Chris or Bob, any insights into sort of potential racial disparities and how this crisis has hit the mortgage sector?
I guess.
So Barry, I would say, I'm sorry. I would say this. I don't have the specifics from a data perspective, but as I mentioned before, we did do a lot of some analytics around those borrowers who have remained delinquent through this time period, and take a look at had they not engaged us, and kind of trying to understand potentially why. Again, economic access reasons could be, there's other demographic reasons, whether it's age and things of that nature, which really out of that work spawned some of the out-of-the-box outreach activities that we decided to do, whether it's partnering with, again, nonprofit housing counseling agencies and organizations, engaging with our retail community bank partners, which we don't always do, in hopes that different activities, different outreach from different parties potentially could help us engage those folks that, those demographic areas that we've seen that had not engaged us. And we've seen some pretty good results from that. I don't have specific data for you, but I think those activities and our analysis align with what you're speaking of there.
I was just going to quickly add, I know we released some data in the fall that went through August, and at that point you didn't see any meaningful differences. But I also think both Bob's comments and what Barry was saying is really significant around the equity position going into the crisis, right? And if you just look at the racial and ethnic composition of FHA, it's no surprise to anyone in this group that you've had lower, tends to be minority community, often have lower down payments. And so there's just less equity there. There's just less wealth, intergenerational wealth. And the unemployment statistics for African Americans and for Hispanics have been worse. They spiked higher. It's great to see them come down, but those communities have been hit harder. So it's going to be a real issue and a focus for policymakers going forward.
Bob, any insights or any feedback from your members you've been seeing?
One of our principles in getting our weekly surveys going was to make it fairly fast and easy for our members to complete. So we did not go into the racial and income breakdown. So we don't have much to add on that point, except I would certainly agree with Mark about his comments about a focus for policymakers. And given that people of color have suffered much worse through physically through the pandemic as well as economically, it's certainly an area to focus on.
Thank you. One of the questions from our viewers is, what if you don't have a government-backed mortgage? Are the CARES Act provisions still applying? And what if you have income and the bank sort of declines to work with you? Bob, can you talk about how across the industry that's being managed and how your members have adapted?
Sure. The questioner is correct in saying that if the mortgage you have is not federally backed, which typically means Fannie Mae, Freddie Mac, USDA, FHA, and VA, if it's not one of those, in other words, if it's on a bank's balance sheet or if it's in a private label security, for instance, the CARES Act does not apply. What we have found in our conversation with servicers who are members of MBA is that they are typically affording similar or the same forbearance options to borrowers, even though the federal law does not require them to. So that's not a guarantee because it's not the law, but that's what we're hearing from our servicers. And I would remind everyone that it is not in the servicers, it's not to the servicers' benefit to see these loans go bad. That nobody makes money when a borrower is unable to make payments and goes into foreclosure. So in terms of, are there servicers who are hearing from borrowers who have income and want to make their payments and are not working with them? I would encourage you to contact me directly, bob@mba.org, very easy email address, bob@mba.org, and give me some details. I'd be happy to dial up the CEO of that company and chase that down, because that is certainly not in anybody's interest.
Bob, thanks. That's a terrific offer, and I hope if people are struggling, they'll take you up on it. Let me stay with Bob for a minute. Bob, when this all started and the forbearance provisions were enacted and people began taking them, there was great concern about potential liquidity issues for mortgage servicers, especially but not only for those who are in FHA mortgages where they're obligated to forward the payments and there really is no option for Ginnie Mae, for instance, to buy out the mortgage and relieve them of those responsibilities. And there was a flurry of activity to try to see if it would be possible or necessary to create a servicer liquidity facility through which they could get low-cost capital to tide them over. What's actually happened with that, and what's the outlook for the servicers who, in the end, are the ones responsible for collecting and forwarding the payments from consumers?
Yes, Barry, this is a unique feature of the U.S. mortgage system where investors are insulated from borrowers' inability to repay by the servicers being required to forward the payment each month to the investor and ultimately, in your example, the holder of a Ginnie Mae security, which, as you know, has 100% full faith and credit guarantee of the US government, even if the borrower is not paying, and that obligation on a Ginnie Mae security extends until the loan is liquidated, meaning that it could last years. And we were nervous, and we could be accused of saying the sky was falling, I suppose, because we were headed into this great unknown. We had no idea how many borrowers would avail themselves of the forbearance option. We had no idea whether the enhanced unemployment benefits would be sufficient to have people keep paying, which we believe, and I think the research we saw today from the JP Morgan Chase Institute backs that up. They took those enhanced unemployment benefits and kept making their mortgage payments. We didn't know any of that. So we were very concerned, particularly for our non-bank members, because typically our bank members had sources of liquidity to draw on for this. And our bank members are less likely to service FHA loans, which are the loans that are in the Ginnie Mae program that are most prone to be in forbearance. So the short answer to the question is that our servicers were able to identify other sources of liquidity. The strain on their liquidity was not as great as we had feared it might be. And because of the Fed's action, which I should mention is pumping billions of dollars of relief and stimulus into the economy in the form of lower mortgage payments at zero cost to the taxpayer. So I think it's been a tremendous part of this government action. Because of all those refinances, and of course you've read about record purchase volumes as well, most servicers also have an origination arm. So they're making a lot of money making new mortgages, which further enhances their liquidity position. So I'm happy to say that the liquidity issue for servicers did not materialize, and things have gone very well.
Terrific. Thanks, Bob. So you raise an interesting point I'd like to ask Chris and maybe Mark to address. Are what we're seeing in the wind down, we hope, of the pandemic, another one of these tales of two cities where those who have are able to get more in terms of a trade up into another home purchase, and while those who are struggling, basically bear the brunt of the economic consequences of the pandemic through loss of their home or inability to build equity? And what are the implications of that going forward? And I'm curious what you're seeing in this current market, where, as Bob says, home purchases are up, which is not what you would have necessarily predicted. Foreclosures, of course, are not up, which many people feared. But there is this concern that we're seeing a further attenuation of people's ability to deploy access and profit from capital and assets, and whether that has, again, a racial dimension that will exacerbate these historic intergenerational and intercommunal differences in wealth and ability to prosper in society. So, Chris, I don't know, what in your market, how are you seeing this play out? And are there differences in the kind of purchase money applications of the applicants you're seeing than before the pandemic? Is it pretty much the same?
Barry, I think Mark's probably going to be more apt on this particular topic, because I don't see as much, obviously, on what's going on our front end, other than to say it's the volume is extremely, extremely high. And we do, at least, early on, have seen quite a few folks that were in forbearance. We've seen a lot of the exits move out by those borrowers to go ahead and move forward with some sort of refinance or other origination type of activity. So we're definitely seeing that's been a large percentage of our exits. So maybe Mark can speak a little bit more on to the front side of that question, but yeah, definitely seeing that as being a large part of our exits.
Sure, I'm happy to do that. And Barry, it's a really interesting question, and it's I think if one breaks it down, just to start with, for the income component versus the asset component, in the short run, the government stimulus has been so large, and actually I think the JP Morgan Foundation has done some really fantastic work showing what's happened to income in people's checking accounts because of the supplement of the state level unemployment, which in a lot of states is only 30% of your prior income for 12 weeks. So there was undoubtedly a need for that supplement. This was a pandemic induced government shutdown of the economy, very different from a normal recession. On top of the $1,200 originally, plus the extra stimulus money, you actually see the savings rate now pretty broadly is substantially above where it was pre-crisis. And for a number of lower income workers who've kept their job, they've actually perhaps had more income this year than they had previously. Now, when you go to the asset side, that's a very different story. And also, if you look at savers, it's a different story. So as Bob was mentioning, we've had record low interest rates, another 100 basis point decline in mortgage rates in 2020. That has allowed many people to refi. That has transmitted the monetary policy, but that really gets mostly transferred to owners, not to renters. And the flip side of that is retirees or others with modest savings who have their money in a checking account rather than having their money in the stock market. So when you get to the asset side, you start to see homeowners have done well because of the appreciation in home prices. Arguably, not to get too far into stock valuations, but the stock market has benefited from really record low interest rates, but not everybody has those assets. So it's going to be a thorny subject for a while.
Terrific. Thanks. So questions from our listeners. Somebody wrote in to say, and I'm going to read it because it's a complex question. To what extent are borrowers able to access payment deferrals after their foreclosure period is over if they can't make a lump sum payment where the missed payments are payable upon maturity of the loan or earlier upon sale or transfer? And is this option dependent upon the options offered by individual servicers? Bob, do you want to take a crack at that?
I do. I was very involved with working with Fannie and Freddie, but most importantly, in this case, FHFA, to ensure that just such an option was available for GSE loans. It took it a little time to get over the finish line, but I'm happy to say that if you have a Fannie or a Freddie loan, an FHA loan, and I believe VA and USDA are there as well, you have an option to, when you're back on your feet financially, not to have to make a lump sum to pay off the forborne payments, but to have those payments due and payable when the loan is paid off. So when you refinance your loan or when you sell your house and pay it off, you would owe the forborne amount without any interest on that amount. So it's a tremendous way for, and the most predominant way that people exit forbearance is to take advantage of that. So I guess the implicit question is, what if your loan is not government backed? There, the servicer does not have that obligation to offer that. So there could be some variation in that, but what we're hearing is that many servicers are making that available despite it not being a federal requirement.
Yeah, I think I was going to follow up on this. You know, one of the maybe the key pending question, as we discussed earlier, is what happens when the forbearance periods end? And we currently have a system where, depending on who the guarantor of your mortgage is, whether it's a portfolio lender holding it on balance sheet, Fannie or Freddie, or one of the other governmental agencies, the loan modification processes that are available to consumers are actually very different depending on which channel your loan went through, which is usually not a consumer choice, but a lender investor choice. And one of the challenges is going to be to try to find a way to help consumers understand both what their options are and try to see, I would argue, whether some narrowing of those differences and the establishment of a standard loan modification waterfall, as FHFA has done with the GSEs, is something that we could pursue as an industry to help consumers get over this next hump more easily. We're sponsoring some research at CFA looking at how these different options affect consumers, and there's no question that depending on what channel you're in, the resolution of your mortgage through the currently available loan modification programs can have very, very different outcomes for both the consumer and the lender. And in some cases, not really the best outcome for either one of them in terms of optionality of the outcome. So I think that's an area we're going to have to do some further work in going forward. Frank, one of the questions is there specific pending legislation at the state, local, or federal level or policy that advocacy groups can support to ensure the protection of vulnerable groups in our communities? I mean, I'll say at the national level and ask Frank to talk about locally. With the Consolidated Appropriations Act, when the HEROES Act was first adopted in Congress earlier this year, it did extend the forbearance requirements to all mortgages, basically, not just those backed by a federal agency. That did not make it into the Consolidated Appropriations Act, at least as far as I can tell. And so currently there are differences in that. And it's possible, I suppose, that the Biden administration and the new Congress, especially coming up to the January 31st expiration of the rental eviction moratorium and the expiration of the forbearance, might turn around to address this. Part of the answer. Frank, any insights into state and local work that advocates should be aware of and stay focused on?
Well, just at the state level, I mentioned it earlier that we do have at the courts, the suspension of the issuance of the notice of intent to foreclose, which expires at the end of January, but does have provisions in there that the governor's executive order imposes on requiring notice being given to anyone who receives a notice of intent about forbearance options. So these are good. They're not things that we're, have specific proposals on how to expand or extend. The courts actually are the ones who suspended the actions on notice of intent. Our challenges are functionally going to be the communication and counseling, and we are focused with the new the rental assistance brings funds, which will help us with some of that on the rental side. But more broadly, there's nothing proposed that I'm familiar with at the state. We do have legislation that's very long list at the state on a variety of options and support for our homeowners with expanded legal and counseling resources would be the area that we're focused to try and determine what we can do locally with existing funding as well as going into the new budget cycle. So it's, I'd say that's our focus at the time right now, is supporting the residents by connecting them with all the possible resources available and options and rights.
Barry, may I mention one thing here?
Please.
I was on a call last week with somebody who told me something I hadn't heard before, which is that some counties are using some of the money they've been receiving from the federal, various federal efforts to pay off borrowers' forborne amounts. And specifically, this was a suburban Atlanta county that I'm familiar with doing this. So as a way of avoiding the loss in equity that I talked about before, if you have a borrower who's back on his or her feet, able to make the payments, but has that albatross of the forborne amount being added to the end of the mortgage, some jurisdictions are taking funds and paying that off and working out a way to get that money directly to the servicer so that that is done. And I don't know whether that's, I know every dollar is scarce, but that is one thing that I've heard in the market.
Interesting. We should all keep our eyes open. So we're coming to the end of our time, and I want to thank everybody on the panel and in the audience for joining us, and I don't want to impose too much. So as a final lightning round question, just a quick answer. If we were to convene this panel a year from now, understanding that unemployment remains at historically high levels, the vaccine is rolling out, but we're far from having achieved herd immunity, will we still, in a year, if we had this panel again, would we still be discussing how to manage consumers in forbearance on their mortgages, and how big a weight will this be for the mortgage industry to be carrying behind it a year from now? So quickly, Mark.
I have to find the unmute button. I mean, I hope the premise of your question is wrong and that a year from now we'll have actually succeeded at vaccinating and unemployment will continue to decline. So if your premise is right, then yes, we'll still have a lot of work for all of us that we have to do, because ultimately keeping people in their homes or managing some sort of graceful exit as the two ways that things get worked out, right? There's not a lot of different outcomes.
Terrific. Jen?
I would hope that everyone's vaccinated by then. But I do think that enough harm has been done to the economy that we're going to have a lot of long-term unemployed folks. And that's going to be a serious situation. So I think this idea of forbearances, or perhaps just maybe loan modifications, will be a significant issue even into next year.
Terrific. Chris?
Yeah, hard to find a different viewpoint from what you just heard. I think that this extends definitely a very deep, or we're dealing and working with borrowers all the way through 2021 and definitely into 2022. I just think you're going to, whether it's forbearance, which we've seen a lot of slowdown in the initial forbearance request volume, but the 12 months, you've got folks taking their first forbearance, right? You got folks taking their first months of forbearance now. So, they're afforded, protections that the CARES has provided. And so, we'll be working with borrowers through, 2022. And, those that remain are going to be, those needing the most help. And whether it's a retention option or where I think you're going to end up seeing potentially is a lot more education around liquidation options and graceful exits, unfortunately. So yeah, I long-winded. We'll be working through this for quite some time.
Frank?
Yeah, I believe that the damage is being done and continues to be done to employment, small businesses, and we've mentioned it, but the disparate impact, the impact that this is having and will have in our communities of color, the immigrant communities, where your first generation homeowners, et cetera, that you need as much assistance and as much connection to resources and modifications. I don't know what we'll be talking about a year from now, but I think we will be dealing with, trying to recover from that level of impact, and that we really, as an industry and a financial community and a general community, need to prioritize making the counseling, the information, the support resources available. So again, we lost so much ground in the last cycle on homeownership and equity and just not equity, but fundamental economic equity. We really have to learn from that. I hope that we'll be talking about how we're doing it better this go round.
Bob?
I'll end on an optimistic note. I think that while this will still be an issue a year from now, the numbers will be so much reduced because of the vaccinations, the bounce back in the economy. We think that the second half of 2021 is going to be gangbusters for this economy. And even borrowers who are in professions that have been most affected, we believe there's such a pent-up demand to see people face to face, to see other parts of the country and the world, that travel will bounce back significantly, as will a lot of the entertainment and restaurant things that we all miss. And the other thing I would say is that I'm afraid that the strains on the rental side of things will be more long lasting, because there's not a neat solution there like there is on the first mortgage side of putting the money at the back and say, we'll deal with it later. The rent is due, and the landlord has to pay the mortgage. So that's I think a longer lasting problem, and also because the people in the service jobs that have been most hard hit by this economic catastrophe are more likely to be renters than homeowners. But on the homeownership side, while not downplaying the extent of the problem a year from now, I do believe it'll be substantially diminished.
Well, thanks to all of you. I would just leave by saying, just adding to my 2 cents on this, that I think, as a couple of you have already mentioned in this last section, trying to ensure that we keep a racial equity lens on solutions, and that we don't allow past patterns of discrimination to be replicated in the way we recover from this economic tragedy don't get extended. Bob, I'm thinking particularly about, you know, local governments that offer to pay off mortgages, making sure they, if they're making that offer, that it's extended in a way that is equitable and has broad access, for instance, right? And doesn't reinforce patterns of discrimination and segregation we've seen in the past in the housing and mortgage market, unfortunately. So with that, I'm going to turn things back to Barbara and Diana. Diana, thank you for all the work you did in setting this up. Barbara, thanks for your leadership at convening these sessions and all the great work you do in Montgomery County. And please take us home. Thank you to the audience for taking time to spend with us this morning.
Thank you so very, very much. Diana, did you want to say a few words?
Just my own personal thanks for your time and wisdom and experience. The audience hung in there with you, and that's a testament to really the value of what you've shared with them today. And I hope that we can, you know, later in 2021 reconvene the group to check in and see how it's playing out. And I encourage everybody that's been on the call. We'll put the recording on the website. Feel free to share it. And be looking for additional panels on other housing related topics in the coming months. And we have a journal with articles from a lot of people in on this call and in the industry with their 2 cents on what's happening with affordable housing, a lot of it related to the pandemic. So be looking for that. And thank you very much. And we'll be in touch.
And maybe next quarter, we'll reconvene and see where we are, hopefully in a very different place. We'll see.
Very good. Thank you, everybody. Stay safe, be healthy.
Bye.